Okay, hello, financial accounting students. For this video clip, we are going to practice how to record accrual basis accounting uh, for the revenue and expense recognition with the matching principle. As we already discussed in the class, the accrual accounting records when transactions occur. It is required by the generally accepted accounting principle. Then we record the revenue when earned and the realized or realizable, and expense when incurred. But the cash basis accounting records when cash receipt or payment. So in the real business, we don't follow cash business except for very small proprietorship business. So let's get started for this example. Purchased inventory. Purchased inventory. Oh, this company is merchandising company selling the smartphone. So the company purchased January 5th a smartphone on credit for sale 500. So it is asset up. So inventory in the company now up. But the company doesn't pay this smartphone the cost yet, but has a liability to pay this the inventory cost in the future. So accounts payable is 500. This is obligation to pay the cost of this inventory. Now the January 10th, the company as one of the managers, a manager in this company count the inventory 1, 2, 3, 4. Is that the transaction? No, it's not the transaction. In order to be a transaction, it should be some subject has the same value and give and take because it's transaction, right? But it doesn't have any transaction, so no entry. Or you can just skip. But in order to be sure, I just wrote down the no entry. Now they paid $200 to the vendor. So accounts payable 500 should be reduced because the company paid $500. So accounts payable, how much is that? Right, by the amount the company paid. So the cash also down. And then 6 days later, January 31st, the company also paid the rest of the amount, $300. So the cash out. When the asset decreased, it should be recorded on the credit side. If the liability increased on the credit, decreased on the debit side. It's opposite side. You have to remember that, right? The debit is asset part, and the credit is asset and liability. As it looks like the T balance of the balance sheet. Okay, then sales part. The revenue recognition earned and realized or realizable. Do you remember what is earned? In order to be this in order for the company recognized as a revenue, it should be earned. That means that delivered, given to the customer, and the realized or realizable and receive the cash of the compensation or cash to receive or the account receivable. So sold the smartphone on credit. Okay, it sold all the smartphone on credit at a price 800. So let's record sales. Why sales should be recorded on the credit? Because the sales is the equity account, right? Why it is equity account? It's all the income statement account. As you can see, this income statement account end up in the net income, the sales minus all the expenses, then net income. This net income is accumulated into this retained earning. Retained earning is the equity account. So this all the income statement account is part of equity. So when the company increases sales, this sales should be recorded on the credit side, which is the equity side. So sales amount 800. Is the company receive cash? No, it is on credit transaction. So accounts receivable. Accounts receivable, the same amount. Even though the company could recognize the 800, there's no cash received, but the company was able to record sales anyway, because as the accounts receivable is asset account, cash to receive. Then matching principle, based on the matching principle, we have to record the expense or the cost of the inventory. What was that? Right, first, inventory out. Inventory, why? The company sold this inventory, this 500. When the company purchases $500 of inventory, there is no cost of recognition, just asset down, the cash down, and asset up, because the time was the time that the company haven't sold anything. They just exchanged the cash and the inventory. But now is the time to recognize the inventory cost, because the company sold that inventory. Now the inventory is no longer is no longer on the company side. It's out. So how much was the inventory value? Right, the 500. This 500. And then once the company recognized sales, this cost of goods sold, which is the income statement account, should be recorded. How much was that? Which is the same as 500. Inventory cost is the cost of goods sold. Inventory value is the value before selling that is recorded on the balance sheet. Now this inventory is sold. It became now the cost of goods sold that is recorded on the income statement. So as we discussed in class, you have to keep it in mind that the revenue recognition with the matching principle means that when the company recognizes the sales, you always recognize the expense, the cost of this inventory at the same time. That is the matching principle. Okay. Now received $500 from the customer, because the sales the company made was on credit. Now is the time to receive cash. Cash collection, 500. Now once the company received the cash, this accounts receivable is no longer asset to receive cash, because the company received the cash. But still, $300 accounts receivable remained on the balance. Still have a right to receive cash, $300, because the company received only $500 out of 800. Now the company received cash, 300. Now 300. Then by this amount the company received, they have to reduce this asset so that the company doesn't have the accounts receivable on the balance, because the company received all the amount on credit, the 800. So cash up, asset up, and then asset down, the accounts receivable. Okay. Then expense received utility bill. Once the company, as soon as the company received the utility bill, that means that the company recognize expense. When the company incurs this expense, when the company received the bill, then expense recognition when it incurs. So right away, utility expense. Why it is on the debit side? Because it is opposite. All the expenses, operating expenses, that reduce the net income. So it reduces the equity because when the net income decreases, the retained earning also decrease, equity decrease. So the utility expense is on the debit side, is opposite side of the equity. Then the bill 200 until the payment. It doesn't show any payment yet. Until the payment, the company owe this utility payable to the utility company by 200. Now, out of 200, the company paid utility. Oh, let me start from the credit. Cash paid how much? Utility how much? 100, right? Oh, let's say just 200. Let's change it. 200. This 200. So that we want to be clear. So utility payable, now utility payable by paying $200 total amount is now, right? So reduced. So the liability on the debit means, oh, the company doesn't owe this liability any longer because the company paid this cash 200. Okay, now we completed this, the accrual accounting and revenue expense recognition with matching principle. Now let's convert all this journal entry into the T account and created this trial balance to make sure that we record all the business transactions and then finally build the financial statement. Okay, on the cash, where is cash? On the debit, there you go. Then 300. Anything else? No cash and other cash. But on the credit side, we have 2 and 300. Oh, 200. The last transaction. So cash is the debit account. So let me just sum this side up and then sum the other side. So $100 is the cash account on the balance sheet. Okay. Accounts receivable. Do you have accounts receivable on the debit? Yes. 800. And there's no any other accounts receivable on the debit. Then how about on the credit side? Accounts receivable 500, accounts receivable 300. So 800 minus 500 minus 300 is 0. So there's no accounts receivable cash to receive on the balance sheet. And then inventory, when the company purchased this inventory and then paid out, the company now sold all the inventory. So there's no inventory at all. So inventory value on the balance sheet should be 0. How about accounts payable? Accounts payable 500 on the credit because it is a liability. And then on the credit side, 200 and 300. So the accounts payable is a liability. It's nothing. It's nothing on the balance sheet because paid all. And then utility payable 200 on the credit, which is liability, and then paid out 200 all. And then the sales. Now let's move on to the income statement account. Okay, there you go. Sales 800, and then there's no other sales. Cost of goods sold. When the company sold all the inventory, now the company should recognize the cost of the inventory. 500 is the debit account that reduces the equity. And then utility expense also the debit account that reduces the credit, the equity account. So utility expense 200. Okay, I believe we collect all this, the journal entry. Now let's make sure that if we collect all this T account from the cash side, then credit 200 and 300, 200. Then account receivable 800 on the debit, and credit we have 2 transaction, and the inventory 2 transaction, inventory in and out. And then account payable on the debit side when the company paid, and then this 500 on credit, and then the utility payable when they receive the bill and then pay out. And then sales is the credit account, only one account, and the cost of goods sold 500, then utility expense 200. Okay, so we balanced out, so there's no mistake. And one more thing, as you can see that there's no negative account in the trial balance or T accounts or journal entry. There's no negative, so you have to keep it in mind. Now, once we've made sure that all the debit and credit, the journal entry are recorded very precisely, so we can just take this balance from accounts receivable from the T account. There's no inventory because the company sold everything. Accounts payable, do we have accounts payable? No, the company paid all out. And then utility payable also 0, right? Okay, and then the sales amount company made. Then you have to be aware of this. The parenthesis in the income statement, it shows expense as negative value. So the cost of goods sold should be 500 negative. So the sales plus cost of goods sold is 300 gross profit. And then utility expense, assuming that we have only one utility expense, because it is expense, it should be negative. So in parentheses means negative. Then operating income after subtracting this from the gross profit is 100. There's no other revenue and gain or no other expenses or loss. So the income before tax, okay, let's just ignore tax. So net income is 100. So this 100 should be accumulated into the retained earnings. So let's make sure that if the balance between asset and liability and equity are the same, it must be same. So 100. Okay, then we created this financial statement using this accrual concept and the revenue and expense recognition and matching principle. Okay, see you in the next video clip. Bye-bye.